At this point, we're ready to complete step 4 in accounting for leases for lessees, which is performing the initial measurement. Earlier in the series, I mentioned that the economic substance of a lease is very similar to purchasing an asset with credit. And with that in mind, on the lease commencement date, we record an asset and a lease liability on the balance sheet. We refer to that asset as a right-of-use asset to clarify that we do not own it. Instead, our lease payments give us the right to use it during the lease term. So from the lessee's perspective, ASC 842 takes a liability-first approach. Paragraph 842.20.31 states that at the commencement date, we measure two things. First, the lease liability as the present value of the lease payments that have not yet been paid, discounted using the discount rate for the lease at commencement. And second, the right-of-use asset as described in paragraph 842.20.35. We'll calculate the lease liability first, because the right-of-use asset is built around it. One of the components that makes up the ROU asset is the lease liability itself. So to calculate that liability, we identify the remaining lease payments as of commencement and discount them using the discount rate we discussed in the last episode. We'll look at more detailed examples later, but to begin, let's walk through a simple one. Assume we leased some office space and we used a third-party broker to help us find it. The broker located a suitable location and we signed a lease with the landlord on September 1st, 2025. The lease term is 3 years and the space becomes available to us on January 1st, 2026. We made our first annual payment of $50,000 upfront on September 1st, 2025. The remaining two payments will be $55,000 on January 1st, 2027 and $60,000 on January 1st, 2028. We're a private company and we've elected the practical expedient that allows us to use the risk-free rate for this class of assets. So we'll use the current 3-year Treasury yield, which is approximately 3.5%. We also paid our broker a commission of $10,000 when we signed the lease. So from our perspective as the lessee, the cash flow pattern looks like this. We paid $50,000 to the lessor and our $10,000 commission to the broker on September 1st, 2025. Then we have the two future payments of $55,000 and $60,000. And remember, at this step, we do not need to analyze whether this is a finance lease or an operating lease. The initial measurement is identical for both classifications. So now it's January 1st, the lease has commenced, and we apply ASC 842. To calculate our lease liability, we only include remaining lease payments as of the commencement date. We'll handle the payments made prior to commencement later. So we discount our $55,000 payment for 1 year at 3.5%, that is $55,000 divided by 1.035, which gives us a present value of $53,140. Next, we need to discount the $60,000 payment, but that payment occurs in 2 years. So we discount it for 2 years by dividing $60,000 by 1.035 squared. That gives a present value of $56,011. So our opening lease liability is $109,151, which is simply the total present value of the two remaining payments as of commencement. That amount will be credited to our lease liability. For this example, we'll ignore the split between current and long-term, and we'll cover that in later episodes. So that completes the liability side. We measured it in accordance with ASC 842.20.31 by calculating the present value of the remaining lease payments as of commencement. Next, we calculate the opening right-of-use asset, and ASC 842.20.35 prescribes exactly how to do this. The right-of-use asset is made up of three components. First, it includes the initial lease liability we just calculated. Second, it includes any lease payments made to the lessor at or before commencement, net of any lease incentives. In our example, we don't have any incentives, but we did make the first $50,000 payment to the lessor on September 1st, 2025, before commencement. And third, we include any initial direct costs incurred by the lessee. ASC 842 defines initial direct costs as incremental costs of a lease that would not have been incurred if the lease had not been obtained. And paragraph 842.1039 states that initial direct costs may include, for example, commissions or payments made to an existing tenant to incentivize that tenant to terminate its lease. In our example, we do have initial direct costs, the $10,000 commission we paid to the broker. Because ASC 842 ultimately requires these amounts to be included in the ROU asset, but only once the lease has commenced, we'll temporarily record them in prepaid accounts when we initially make the payments. So our entries on September 1st would look like this. Our $50,000 payment to the lessor would be booked to prepaid lease payments, and the $10,000 commission will book to prepaid initial direct costs. And now we're ready to calculate our opening ROU asset. As we just discussed, it will be made up of three components. Our initial lease liability of $109,151, the first $50,000 upfront payment we made to the lessor, and the $10,000 in initial direct costs for the commission payment to our broker that found the office space, which means our opening ROU asset will total $169,151. Now with both our initial lease liability and opening ROU asset calculated, we're ready to complete our journal entry for the initial lease measurement on the lease commencement date of January 31st, 2026. And that looks like this. As we stated earlier, we'll credit our lease liability for the present value of our future lease payments, which totaled $109,151. Then we'll need to reverse the prepaid lease payment and prepaid initial direct cost balances of $50,000 and $10,000 respectively, because those balances are now being absorbed into the ROU asset. And finally, we'll record our opening ROU asset with a debit of $169,151. And again, this step is identical whether the lease is classified as a finance lease or an operating lease. At commencement, we record the lease liability as the present value of the remaining lease payments and the right-of-use asset as the sum of the lease liability, any payments made to the lessor prior to commencement, and any initial direct costs. So with that, we've covered the initial measurement and recording of a lease in accordance with ASC 842. In the next episode, we'll begin looking at the subsequent accounting.